Hi, everyone. Welcome to our webinar today, Lessors Risk Product. This is an interesting commercial buildings, how to insure them. And my name is Anae Augustini. I'm CEO of CID Insurance Programs. And I want to introduce Michelle Belden, who's our commercial underwriter who specializes in Lessors Risk. Say hi, Michelle.
Good morning, everyone.
And then Jacob Cole is our marketing specialist, and he runs everything from behind the scenes. Say hi, Jacob.
Hello, everyone.
Great. So let's get started. Everyone knows that what the logistics. You'll be on mute, but you'll be able to hear for sure. But your voice is important to us, so please pose questions as we go along throughout the webinar in the chat room, and we'll stop and answer them as they come in. So again, please feel free to ask any questions, and there's no wrong question to ask. And then we'd like your feedback. If you would take the short survey at the end of the webinar, we'd appreciate it. So let's talk about objectives. It's going to be important to understand the different types of commercial buildings, so you'll be able to do that while Michelle will talk about that. And then you're gonna learn about the underwriting guidelines that you really need to consider. And so you'll understand how the property components need to be considered when insuring a commercial building. And then what's the secret to the fast quotable submissions? So without further ado, I'm going to turn this over to Michelle.
All right, good morning, everyone. Okay, so like Anae said, we're going to talk about Lessors Risk today. That's probably one of my favorite products to write, which is a good thing because I'm pretty good at it. So I just wanted to go over a basic definition of what a Lessors Risk is, because I know sometimes people get a little confused on this. So a Lessors Risk provides liability and property coverage for building owners. So what we want to do is we want to differentiate between a building owner and then the tenant of the building, because they are two separate risks. So the building owner obviously is the one who owns the building, and they either, as the building owner, can occupy the building themselves, or they can lease it out. And if they're leasing it out, it's going to a tenant. And so the tenant is the one that's leasing the space from them. As the building owner, they are the landlord, and so they're responsible for insuring the building. Unless in their lease they have a triple net lease in place with their tenant, meaning the building owner is transferring the responsibility of who is to insure the building onto their tenant. Then in that case, the tenant would be responsible for not only their liability for their company, but then also covering the property for the building. So, it's not something you see all the time, but it is definitely something out there, and it is something that we can consider as well. Next slide, Anae, please. So I just want to talk about a few different types of Lessors Risk buildings that you'll see. Commercial buildings are all over the place. We'll have some pictures that I'll show you as well as I'm going through these. So your professional office buildings, really, those could be medical centers, straight office buildings that are made up of like lawyers, IT companies, just where it's just pretty much professional office. There's no retail spaces. Then you have your traditional commercial buildings, which would be your retail spaces, like your strip malls or, where there's a restaurant, things like that. That would be your more typical commercial type buildings. Then we also have mixed use buildings, which they have commercial and residential. So generally speaking, it's the bottom floor, has a few commercial tenants, whether they're retail, restaurants, offices, what they may be. And then your top floors, if there's multiple floors, are generally your residential apartment units. So that's definitely something we can insure as well. We just we'll talk about how to break that down to get a quote on that when underwriting it. And then I mentioned retail strip malls. And then you have, just wanted to put it out there, there's business park associations, which we call commercial PUDs. Those are a little bit different than Lessors Risk because they are part of an association where they, as unit owners in that association, pay dues to create that association and maintain that association. So it's different because there's multiple owners, whereas a Lessors Risk, there's, only one building owner, whether, if that's a partnership or whatever, that's different than there being 10 units in an association where there's 10 separate unit owners making up that association. But the business park association, they're only generally responsible for the exterior of the building. So then there becomes the interior building. So if you own a unit in a business park and you rent that out, we can still help you for coverage with that. It would be considered a commercial condo, which is no problem, and we can insure the interior of that unit for you as a lessor's risk. So just some pictures just to show you. So the professional building, generally speaking, it could be multiple stories, and each floor is occupied by a few different offices and things like that. So that's what you would see there. Your typical retail strip mall, made up of all retail and restaurant tenants that you can think of. That's what you're going to see for a retail strip mall. And then your commercial building is like what I was just talking about for the associations. That's generally the type of building that you see. They're either office parks or they're light industrial type buildings. But again, like I said, the association would be responsible for insuring the building, but we can help you if you rent out, if your insured rents out their portion of their building to a tenant, we can write that interior coverage for them as a lessor's risk. And then your mixed-use building, as I said before, would have your commercial spaces on the bottom and some residential on top, or however the building is set up. And then before we get into underwriting, I just wanted to talk about a couple things that I've been seeing as a result of COVID-19. All the carriers have taken various stances and things like that. So right now, some carriers aren't offering business income, or they're limiting how much coverage that they will offer under that. For the lessor's risk, it's not, I haven't seen it be as affected, as you say, for other types of risks. And then also I know certain carriers are not wanting certain types of tenants at this time. Some carriers, don't want to take on restaurant tenants. But as things begin to open back up and, we continue to move forward, hopefully these restrictions and things will be lessened and then removed altogether. So that's all I wanted to say about that. So some underwriting guidelines to consider. The main thing I need to know for a lessor's risk is what type of tenants are in the building. That's going to determine what markets I can go to. Because, if you've got a wood manufacturer, I'm going to tell you a preferred market's not going to take it. So you're going to have to go to an E&S type market. So we want to know the difference, the types of tenants in the building. That's extremely important. Your most preferred type would be your professional office tenants, because you're going to have less foot traffic than you would, say, a retail strip mall, where, people are coming in and out of that place all day long. And then we also, so anything that's warehouses, retail stores, light manufacturing, those are all great. The harder to place type tenants generally are ones that have garage repair type risks, restaurants, furniture, wood manufacturing, and cannabis related tenants. We can consider them. It does vary by what their operations are, if they're a grower, a manufacturer, or if they're a retail store. We have markets that we can look at those. I know it's becoming a growing industry, so it's definitely something that we can take a look at. And then if they have multiple tenants, generally speaking, if you're a good building owner, you would keep what we call a rent roll, which provides you with a list of your tenants, the square footage they occupy, and then, what their monthly rents are, and then any other information as that building owner wants to keep on file for them. So a rent roll is really important to me, because if there's multiple tenants, it helps me, A, determine where I can place the risk, and B, it breaks it down for me based on the square footage. Because sometimes, if it's heavy on one side and then a little bit lighter with the types of tenants, it will definitely affect the types of tenants that the carriers that I can take it to.
So Michelle, we've got a question that I think you can answer. What is the oldest building you can insure? For example, something that was built in 1948.
I can definitely write something that was built in 1948. I think the oldest building I've ever written was built in the late 1800s, like 1890. But with the older buildings, and definitely we'll get into this on our next slide as well, so if any of you want to jump to that slide, we can talk about that. for the older buildings, it's not a problem. I actually like the older buildings, but for the older buildings, we're looking for complete and full updates to the wiring, plumbing, heating, and roof within the last 30 to 35 years. It varies by carrier. For them to be able to qualify for special form replacement costs. If they don't have the updates, and the older building and they still need the coverage, I can definitely write it as basic ACV. With the older buildings, if they don't have the updates, it will limit the markets I have available, because some carriers are pretty particular about what age they will start writing buildings at. Some of your preferred markets are, wanting things from 1970 and later, and even 1970 for them is starting to get a little old on their side. So, but I do have markets that will consider those older buildings, no problem. With the updates is much more preferred because it opens up some more markets for me. Without the updates, we're generally looking at E&S type markets for where I could take those ones. And again, it would be basic form, and then ACV for your valuation. So the building itself, I've seen some older buildings that look nicer than buildings that were maybe built in the 90s. So, again, it comes down to your pride of ownership and how well you're maintaining the building.
Another question came in about historical buildings.
Historical buildings are a little bit tough. I generally can only consider those with E&S markets. I don't get too many historical building requests. I have come across a few in the past, but I don't get them very often. So we're definitely not a niche in that arena. So I don't know if there's other markets out there that, specialize it and are, giving them coverages that would apply more to historical buildings, but I can consider them. They're just not the easiest for me to write. All right, some other things to consider about the building, other than the age. How many stories is it? That will become a factor, because once you get over a certain number of stories, we wanting to know, especially if it's frame, and in California, if it's frame construction, generally over 3 or 4 stories, most of your markets are looking to see if that building's sprinklered. Obviously, on the older buildings, it's most likely not. But I do have markets that will consider non-sprinklered buildings, over a certain amount of stories. That's not a problem. But again, sprinklered buildings, yeah, that's great. They generally has a room to offer you another credit available if your building is fully sprinklered. Other things to consider, all these things that are listed are definitely things that would be checked on in an inspection, which most of our Lessors Risk, with whatever carrier replacing it, will most likely have an inspection done on the building itself to see the condition of it, make sure we're rating it properly, and make sure we're helping the building owner, lessen their chance of having a claim. So you would want to make sure that your sidewalks aren't uneven and the parking lots are paved and don't have potholes in them, so people aren't tripping and falling, and then turning around and suing the building owner for hurting themselves while at their premise. If there's multiple stories and there's a stairwell and there's upstairs and there's railings, you're wanting the railing width, generally speaking, 4 to 6 inches. 4 is better than 6. Once you get over 6, nobody really wants that. So you would need to be either looking at redoing the railings or inserting some sort of like mesh in front of it to, protect people from, especially toddlers or small children, from falling through. And we're looking at vertical railings instead of horizontal. Horizontal railings are, I know, becoming something contractors are liking to put in newer buildings right now. I've been seeing that a lot lately, but on insurance purposes, it doesn't really work for us, because if you have a horizontal railing and you've got multiple, it almost acts like a step ladder. So you can just climb right up and then get to the top and say you're a toddler and then fall over. So again, if you have horizontal type railings and that's found in an inspection, one of the cheapest ways to correct that without having to redo the whole railings is to insert some sort of like mesh around it to protect it so you can't climb up and down it. And then we were also, your tenants for the building owner, they should always be naming their building owner as an additional insured on their policy, and then providing the building owner with a certificate of insurance, proving that they have their own insurance in place, and that is something that is required with all of my carriers. So if as a building owner, they don't require their tenants to carry insurance and provide them with the COI, I won't be able to assist you because, again, this is something that they're going to confirm in an inspection, or they may even require the certificates of insurance at time of buying to prove that their tenants have the coverage in place. All right, so let's talk about a statement of values. So a statement of values breaks down, so if you have a building that has a complex that has multiple buildings in it, or say a building owner owns 5 locations and we want to insure all 5 locations on one policy. Well, I can't offer a blanket limit because each one is going to be its own limit. So I need a breakdown of it. So that's where the statement of values comes in. So really the most basic information I need for a statement of values is a breakdown of how many units there are, the square footage, and what limits you're looking for that building. And then what I mean by units is that, if they have commercial units and residential, so I'd be looking for the number of residential units versus the number of commercial units. And then, so we need a breakdown of each building. Super simple. I have an example of just a basic SOV that we have available. Again, I see ones that are fully detailed to this most basic information. I just need enough information to be able to get you guys a quote. And I don't want to make you do more work than it needs to be. We want to make this as simple as possible on both ends so we can turn this around and hopefully close the deal as fast as possible. Some other things to consider for property components that you would want to include on the statement of values are, property that's attached versus detached. So say they have a trash enclosure. That's a separate building from the normal building. Well, we want to make sure we're insuring that trash enclosure as well. So that would be its own limit. And then, but say they have a fence. Is that fence connected to the building, or is it just freestanding? If it's connected to the building, you want to make sure that portion is included in your building limit. If it's detached from the building, then again, it would be a separate limit. So that's how you can determine, what components you would need to figure out for your building limit. Is it attached or is it detached? So that way you can break it down appropriately. Some buildings are just a building and that's it, and that's it. So that would be your coverage there. So like I said, a pretty basic SOV, just listing out what building they have, what location it's at, and then again, if they have any other property components that they're wanting to have insured as well that are separate and not attached onto those buildings, you could just list those out and we can get that rated accordingly. All right. So determining a building limit. There are various ways to do that. Obviously, if you have an existing client, you can go off of what their current coverage is. For me, I do a check when I get a submission in. So if you tell me the building limit is $1 million and then you're telling me however much the square footage is, I will divide the limit divided by the square footage to see what the cost per square footage comes out to. So I generally see anywhere from $100 to $250 for the cost per square footage. And, sometimes I get things and it seems awfully low. I'll get things at $50 a square foot, and that doesn't seem right unless it's a real simple, basic metal building or something where there's not a lot of coverage needed. So, that's something that I'll definitely be checking. And if I feel like the limit seems kind of low or seems really high, I would be looking for some sort of explanation or some sort of backup to prove that the limit is correct. So the backup that I generally am asking for is a replacement cost estimator. And, there's a bunch of services out there. CoreLogic is one that I see most, where you can run the building and it will calculate the replacement cost for you. So we would be wanting to make sure we're within that range to make sure we're insuring the building for the appropriate limit, because you don't want to underinsure them in the event they have a loss. And then, if we're overinsuring them, it could become a premium problem if they're, trying to save money. So if we're at that replacement cost number, and that's great. So things that go into it with that is the construction type. Like I said, a metal building is going to cost you less to repair or replace if there was a full loss than, say, a frame building. So those are things to be taken into consideration. Also, how tall is the building? How is the building maintained? What quality is it in? So that's what we're looking for when I'm looking at the cost per square footage and your building valuation. Next slide, Renee, please. All right, so let's talk about what coverages are available. So we can write them a package, which would have the property coverages and the general liability on there, or we could write them if, as a building owner, they don't have a loan on the policy or they're not concerned, or like I said, they've transferred the risk over to their tenant to insure the building in that triple net lease. They're only looking to get the general liability for themselves to protect them as the building owner. Or we can write the monoline property if they're not concerned about the GL. I would suggest always writing the package, so how you having the property and the GL, so that way, they're covered in the event the building is damaged, in the event that, somebody trips or falls on their premises. So with the property, the building coverage is obviously your most important. Then also your business income, which would be your loss of rents. So for that limit, I can't offer an ALS. I need what their annual rents are for that one, so I need that. We can offer building ordinance coverage. If generally speaking on an LROs, you don't see BPP as often, but we can offer it as long as it's BPP of the building owner. We don't want to cover any property of the tenants. That is on the tenants. They need to insure their own property. But say, in a strip mall, the building owner provides tables and chairs to sit outside. That would be their BPP. So we could ensure that that's not a problem. Again, we don't want to insure any BPP of the tenants. And then for the general liability, we can also add on the hired and non-owned auto for that, just in case exposure. And let's see. And some other things, but generally speaking, you're not going to have a GL deductible. Some carriers may have one, depends on what market you're going to, but most of the time there's no GL deductible. We talked about the types of coverages we can offer, so we do have special form replacement costs available. If it's an older building, again, we're looking for the updates, complete and full updates within the last 30 to 35 years. Otherwise, we can do basic ACV if they don't have those updates, or it's not a newer building where we're not as concerned about the updates. GL limits are going to be your standard 1-2. We have some markets that will offer 2-4, but most of our markets do offer 1-2, but not a problem if they need higher limits. We have excess markets available where we can write you an excess up to $10 million if that's what they're needing. And then, property limits are going to vary by carrier. Each carrier's got, their capacity and where we can go. But, I can consider things up to $50 million, depending, again, on where it's located, the condition of the building, the age of the building, the occupancies, things like that will be taken into consideration. So definitely if you have, any questions or things like that, feel free to reach out to me. I'm always happy to discuss the risk before you put a whole submission together, because I don't want to waste your time or anything like that, because I know it's valuable. Okay, and so this little form we created is a risk profile, which is available on our website, and it's a great little tool if you're just talking to somebody for the first time, and it's not an existing client of yours. So you can just take down the basic information. So that way you have it all here, and then you can transfer it over to the appropriate accords or supplemental applications that would be needed. So this is also really helpful if you have a new purchase. New purchases are something that we can definitely write. So, sometimes they wait until the last minute when they're like, oh, we're getting ready to close escrow. Oh, well, now we need to get insurance. So, you may not be able to go visit the property right away, or they're just calling you real quick. So you can take this basic information down, and it will give you enough information to be able to transfer it on to a court application to send in. Unfortunately, can't quote off of this because it doesn't give me all the information I need about the building, but it is a good tool for you just to have on file, and or even send to your clients for them to fill out to you, so you can get some basic information, other than where you would go just by Googling the property and things like that. Believe me, I Google properties all the time and look for things. So you should definitely, if you're not doing that already and you can't go visit the property yourself, I definitely suggest Googling it. It's not always the greatest, depending on where they're located. Your Google pictures could be extremely outdated, but it's a good place to start. And then, so what do I need for a submission? In order to get a submission, I need an accord 125, 126, and 140. Make sure that there, a list of the tenants is included, whether that's in your email, the separate attachment, or it's listed on the accords. I need a breakdown of what tenants are occupying that building. And then we do have a supplemental application, which is extremely helpful for me, especially if there's restaurant type tenants in the building, because it goes over those like controls for as long as having the appropriate systems in place to protect the building. So that's helpful. And I can quote off of not just my supplemental, I can quote off pretty much any supplemental. If there's anything I'm missing from you in a submission or that I'm needing, I'll always reach out to you and let you know what else is needed. If they have existing coverage, loss history is extremely helpful. I know sometimes as the agent, you're not the incumbent, so you don't have access to that loss history right away. It's not a problem. I can definitely quote without it. But if you do know ahead of time that they have losses and you don't have the loss runs, getting me a loss history, just, in an email or something saying, hey, they've had this loss and I don't have the specifics on how much it paid out, but this thing like that, that will help me because it's definitely something that will be considered in underwriting. Because some carriers can make their decision based on, if that loss open or closed, how much ended up being paid out can affect like what market I can go to and if I would have coverage available for that one. If you have a target premium, that's always helpful. Sometimes I can tell right off the bat if I'm going to be competitive or not, and I can definitely let you know. And then, so all of our applications are online. They're digital. They're available for you to fill out, type in, and print them out. I don't need them signed right away. I can work without them being signed. I don't need them signed until you're ready to bind. But if they do sign, electronic signatures through like DigiSign and things like that, that's totally fine by us. That works, and my carriers don't have a problem with that either. And then again, like I said, for the list of the multiple tenants, a rent roll, or if you just list them out in an email to me, as long as I have some sort of breakdown of those tenants, that's going to be really important because that's going to determine where I can take your risk and where I can submit it to.
Great information, Michelle. Great job. I think you helped people learn about Lessors Risk today. Again, if you have any questions, throw them in the chat room, and even after we are finished, we'll make sure that question gets answered. And please, we're just about to launch our new website. It's going to be just as easy as it was before, but we just put a facelift on it, and so that's going to be coming, I think, June 8th. Our new website, so you visit our website for tools, upcoming webinars, and please take the survey. So phone and web quotable for certain risks, but check with Michelle so that she can at least guide you whether we need an application or whether something can be quoted via our phone and web options. And then Michelle's ready for your submissions, so please send them over to submissions@CIDinsurance.com. All right, thank you so much for joining us, and we look forward to doing some business with you. And for those of you that are already doing business with us, thank you for your business, and let's do more. Take care.